These next few chapters are areas where I'm no expert. I do, however, want to cover them because these are things that you need to be aware of that are available to you, and some of you will learn to leverage these tools and use them to your advantage, but they're not for everyone, especially those new to investing. Now, the first topic that I want to discuss is portfolio leveraging. So, what exactly is leveraging? Say, for example, you've got a portfolio with $20,000. Now, some firms will offer you a line of credit worth up to the value of your portfolio. In other words, in our example, we could take on another $20,000 worth of debt. Now, you might say that sounds incredibly risky, and while you're right, here's what they're thinking. Rather than invest the $20,000, if you're investing $40,000 and earning 8% while paying a lower rate on your debt, you can then use that debt to actually get ahead and make money because of the compound interest working off the larger amount of money that you're now investing. And during bullish times, this strategy can work out quite well, but it's hard to tell how long those good times will last, so taking on debt can become risky. Now in this chart here, this is an example of what it looks like when someone with a $200,000 portfolio invests just the $200,000 versus someone else that chooses to fully leverage their portfolio and take on another $200,000 worth of debt. At the end of the 20 years without leverage and earning an 8% return, you would have about $1 million. Now if you took on the leverage and paid an interest rate of 6.9%, by the end of the 20 years, the loan will be paid off, and if you earn the same 8% return, you'd now have about $1.6 million. So to be clear, you would end up paying about $420,000 in interest to get a shot at an additional $587,000 in income. And while you do get a 58% increase in your overall end result, you have to keep in mind that market conditions are not guaranteed. Investment returns are not guaranteed, and just as easily as you can make money, you can lose it. And the market will have down years, and you might find yourself having to pay interest on that loan while you're also losing value in your portfolio and not generating any income in order to make the loan payment. Certainly, there are safer strategies, like if you can get a loan at an interest rate below a treasury rate. That can lead to safe returns, but this is just something that we want you to be aware of. It's not something that we're recommending, especially if you're new to investing. Use discretion, and please don't take on any unnecessary risk if you can't handle it. This exists as something that larger funds and investment houses will leverage as part of their strategy. You as an individual have to be careful because you can very quickly go bankrupt if you make the wrong calls. Now, if you want to use leverage, have some discussions with a financial professional before taking on any debt. It's up to you if you want to leverage this strategy, but make sure to surround yourself with good people and not just salespeople trying to profit from you. Liquidity is a reference to how quickly you can turn something into cash. And while cash is king, some other examples of highly liquid assets are treasury bills, bonds, and some would also consider like gold or silver bullion. And silver coins are more commonly accepted for personal trade, but buyers for gold are really not that hard to find either. Assets with low liquidity still have value. They're just harder to find buyers for. So, if you need to turn something into cash, it just takes a little bit longer. Now, here are some examples of low liquid assets. This would be owning things like your family home or a farm, maybe an automobile, a boat, an RV. Of course, those things can depreciate. You might even consider artwork or certain antiquities. Now, these are all things that have value. They just take a little bit of time to find the right buyer. And as you build up your investment portfolio, some investors also have commercial real estate and will own businesses. You'll hear a lot of investors talking about commodity prices going up and down. And if you're going to invest, you should pay attention to commodities. Commodities are inputs needed for businesses to provide you with those end products that you purchase today. Now, these can be anything from basic raw materials to food and grain, even things like gases or gems and diamonds, stuff like that. So knowing what raw material inputs are used by your investments will help you better anticipate profits and whether or not your investments will continue to perform like they have. If raw material prices are increasing and corporations are not increasing their prices, that means their cash flows will suffer and so will their stock price. If they're passing along the price increases to the consumer, then the consumer can demonstrate a willingness to pay for it, and you get a better understanding of what the market can accept. So we tend to reference commodities as a way to understand the movements in stock prices and predict future outcomes. Now that can include predicting things like mergers and even industry consolidations. Now, purchasing commodities is something that you can do, and some traders will play in this field. Futures are primarily meant for corporations for purchasing raw materials, but they are often traded due to their fluctuating values. Just know they aren't generally meant for retail traders. If you do purchase commodities and hold on to the futures contracts to maturity, you will need to take delivery. And most retail traders don't have the space to start trading in physical commodities. Large funds can find ways to manage this, but it's going to be difficult for you as an individual. So if you're using them as an investment vehicle, then keep in mind that you have to sell them before their maturity date. Now, we don't encourage new investors to invest in commodities. We just recommend that you have an awareness of their price movements so that you can better understand your investment's performance.